Hey everybody, Luke Ellis here with Rivera Capital. Welcome back. We're going to be talking about why we think deal velocity has been slowing in the M&A marketplace lately. It's not only because higher interest rates and tighter credit has contributed, but it's also that buyers are spending a lot more time digging through a deal. And we do think too that naturally valuations, at least from our perspective, need to collapse some. They've been awfully frothy in the PE space for the last 3 to 5 years. And then additionally too, we think that's going to kind of trickle down to all the smaller deals as well. So it's not just an interest rate play that's happening. Like we talked about too, though, the banks are tightening credit, and that's playing a major influence where we've actually kind of switched our diligence process some to where we focus on the bankability of a deal right up front, so we know we can get it done, because it doesn't matter if you have an LOI if you can't actually go get credit or bank financing on that deal to get it done. So you just waste 3 to 4 months of your life for really no return. On top of that too, buyers are looking for kind of things that are much more buttoned up. So spend some more time on your deal rooms and on your marketing materials. Make sure you look at all the risks and the caveats of the business and kind of the future risk in the business as well. Maybe even build in a contingency process as far as what if revenue goes down by 30% or 40%. That's something we kind of build into our worst case scenario modeling when we look at a deal for a client. But as always, reach out if we can help with anything, and we'd love to talk to you more about deal velocity, credit, or the ever-evolving economy that seems to be shaping up quite frothy these days.
Hey, before we go, if you have someone buying from private equity and we're doing financial diligence, when we see all the engineering happening, all the financial engineering happening, what should they be looking for?
From private equity? Whew. As far as, what do you mean?
I mean, when we know we're engineering the finances to make it look like better returns, is there something in particular, anything in particular that buyers may be looking for in the financial diligence that they're doing when they're buying from PE?
Yeah, I'd say just cut out the projections. Discounted cash flow models don't work if market economics break down and the economy as a whole shrinks, or your niche or industry does. On top of that too, anybody with projections are usually full of shit. We try to write them as basically as real world as we can. 20-25% growth rates, 40% growth rates. That's very difficult to do organically within a business. You can go and buy that, but you're just adding more and more leverage onto that situation. So be very wary of that, sellers, when you're selling to private equity, that a lot of that deal value could be tied up in growth rates that you just cannot hit. So reach out to us if you want to talk more about that, and we can explain how a private equity deal is typically done these days, and give you some tips on how to navigate that.